You're listening to Golden Rule Radio, your weekly discussion of the precious metals markets and the markets closely associated with the metals. Each week, Rob and Miles and I, Tori, will walk you through a technical analysis of the metals charts, as well as covering the underlying fundamentals and news that helps move and predict our markets. Together, we have over 75 years of experience advising on and brokering the physical precious metals, whether that be for possession, IRA, or storage. And today we're going to get into this big pullback in the gold and silver prices and do a little deeper dive on the technical analysis, but still cover the fundamentals and give you a little bit of encouragement for the long term. So Miles, take us off.
So kicking off this week, just a weekly snapshot of gold. Gold down about 3% from our recording on Wednesday of last week. Currently sitting at about 4,100, give or take a few bucks. But from high to low, gold had about an 8.5% move where it peaked out here, I believe on Friday. We had a decline, which bottomed out yesterday on Tuesday and a little bit of a rebound today. So down 3%, but a pretty wild move up and down in gold. And guys, the numbers are going to get bigger as we keep going. So let's shuffle on over to silver. Silver down from our recording last week about 8.5%. Back below $50. Spot price currently sitting in the mid 48s, about 48.50 when I was putting charts together here a little earlier. But silver's entire swing over the last week was as much as almost 13%. I think it was about 12.7%. From high to low, with silver getting real close to that 55 number, I believe, and then coming back down from there. So finally seeing a little bit of break in the metals pricing. Platinum not quite as much as silver, at least from our recording last week, down 7%, currently sitting debatably somewhere above or below 1,600, depending on if you're looking at spot price or futures or which indicator. So we're arguing about that before recording. But let's say platinum's sitting right around split the difference, 1,600 at the moment, but a total massive volatile move in platinum from top to bottom, over 16% from high to low this past week. And we'll just keep going with palladium, platinum sister metal, down 5% from our recording last week at around $1,500, but a total high to low, when you look at the whole swing, almost 18% just in a week from top to bottom. So definitely some short positions getting put on palladium here. Rounding out the paper markets compared to the metals, the S&P coming off about 2 weeks ago on Friday, a pretty significant move down on the 10th. I think we did about 3% down in a single day. The S&P has had a little bit of a bounce here over the last week or two. We're technically up about 0.1% since our recording last week, currently sitting at right at 6,700 with a total swing of about 2.5% in the S&P, and really wanting to push back up towards those 67, 65 highs. So about another 60, 70 points to go to flirt with the previous highs, and we'd certainly like to see that in the equities market. Finally, everything hinging on the dollar. The dollar actually up another 0.3%, sitting just below 99. It's at 98.9, a total move this week of a little over 1% from bottom to top. Now, the dollar is playing around with a declining ceiling. If we zoom out here and look at a bigger chart in the dollar may be starting to bump its head here, or maybe giving us a little breakout momentum. You never really know till it makes a decision, but the dollar is definitely in volatile territory and expecting to see it decide one way or the other here in the next couple of weeks. So, fellas, a lot of big numbers this week. There's a couple different places we could kick it off. Where do you guys want to start?
You know, I'd really like to jump a little bit deeper into the gold chart because of this downturn. All the news is capturing the activity in the gold price. But Miles, if we zoom in on like the hourly chart of gold, on Tuesday especially, and to me, if we just look at the last couple of weeks, it shows that this is primarily a profit-taking type of market activity, in my opinion. So you've got big money that has been driving this spot price move. We didn't see any primary underlying fundamentals change. There wasn't a big new monetary policy shift or a war breaking out or a new rate cut that was twice the size that they expected, something of that nature, a fiscal policy deal where they came out and opened the government with some 1.5 trillion expected spending boost. None of that happened. So as a result, you know that there's some speculation in the market. And the reason I want to zoom in on this chart is, to me, it shows that we've had 6 significant profit-taking scenarios here in just the last couple of weeks. And obviously this week is the biggest. And the reason I say that is because of the steepness of the decline, you know, the rapidity with which it occurs. It's like, wow. And search the news, that's what you hear, is that no pundits feel as if the bull market is interrupted. They all feel as if this is profit taking, like what we tend to see in December.
Well, and it probably tripped some of the stop losses too.
Yes.
Which would create a cascading effect. But nobody's worried. Gold isn't headed back to 2,000. We'll never see that again.
I don't think we will either. And I'm not discouraged one bit. I think what helps precipitate that type of profit taking too is the CME group, you know, as more and more money steps into the futures market and more speculation on leverage is buying gold, is buying silver. And then the CME raises margin requirements. And we've talked about this on the show. Miles, you and I have the infamous margin requirement day when I was fishing and you were holding down the fort.
Don't remind me.
That was...
I had put a wall up around that memory, Tori. Come on, man.
You got crushed. But anyway, the CME raised margin requirements like 5 times in 3 weeks because they were tired of the silver run when it ran to 50 in 2011, and then it was rallying back in 2013. But all that to be said, they raised margin requirements by 8.5% on silver on Friday the 17th, and they raised it by 5.5% on gold on the same day. So maybe that does precipitate it. But I think it's a good chart to kind of zoom in and see what the short-term price action looks like sometimes.
Yeah.
I'm curious, too, where the moving averages are.
Oh, that's a fun one. Yeah, let's pull those up and take a look. And here's the other thing while I'm pulling that chart out of my dusty binder online trading view account. Different charting world than it was 20 years ago. You're looking at gold going up 31% in 2 months. Let the guy catch his breath.
I know.
I don't think we're too worried about this at all, other than the opportunities it provides. And it really provides opportunities for people who are maybe still just learning about how the commodities market as a whole tend to react to certain type of events, or when prices hit certain levels. You know, there's a lot of things involved in commodities markets beyond just what you're going to see in the normal common stock trading price, say on your average Wall Street traded company. There's a lot that goes into it, from production and manufacturing and refining and shipping and orders and futures and options. And so you do want to calculate all that stuff in. I love looking at charts, but there are a ton of underlying fundamentals specific to all commodities, whether it's gold, silver, timber, or soybeans. So we hit our first significant moving average, Rob, today. We hit the 20-day moving average. You know, the big important 20-day average, because who really cares?
You got to hit the first one before you can get to the
you got to hit the
meaningful
first
one.
one before you hit the rest. Yeah. So the 20-day moving average. And what I always love about it is if you really just look at the short-term move up in gold going back to where it really started taking off back in August, that's also kind of right where the short-term 382 fib retracement is. So I love when indicators crisscross over top of each other.
Yeah, me too.
So yeah, sure, maybe tomorrow we get a little bit of a bounce, but arguably what we're going to be looking for here is this a pause? Is this a correction? Is this just a hiccup? And within a week, we're back up to new highs. So there's no real way to speculate at this point the direction outside of looking at some of those deeper fundamentals and how that's affecting things like the futures and options market, and the commitment to traders report is going to look over the next couple of weeks. But it is nice to see that. Now, keeping going down that same train of thought, the next really short-term average that I think you and I both like to look at is that 50-day, which gives us a longer short-term view of where your average price is. Well, the 50-day is all the way down at around 37.20. So that's a good $300 or so below where we're at now. And as of right now, that's right at about where the 618 retracement is.
Okay.
Now that's going to adjust a little bit, but we are seeing the moving averages kind of line up with where your fib retracements are right when the gold market might be starting its next break. And to me, that adds a little bit of likelihood that we may be looking at a little bit of a end of summer, fall pause in the rise of the price of gold.
Well, and it needed to. It needed to take a breather.
I like the way David described it, literally as a breather. You've got a sprinter here. Now, we've been kind of in a 800 event. It hasn't been a true 400 or something smaller, but every 800 sprinter needs to pause, gather thoughts, catch breath, and then take off again. And this is not an interruption of the bull market. We're still running races.
Well, we had a 34% rise from January until April. And then we sat sideways from April until August. Now we've had a 32% rise from August to October. Maybe we sit sideways till around the end of the year. That's perfectly reasonable.
Yes, I totally agree. And then the third heat begins, the championship heat in a sense, where it'll really get exciting come February 1st through the end of the winter into the spring.
Now, Rob, before we turn the page, since you asked, what is your favorite moving average time frame?
Well, I've always been focused on the 200-day, especially as we hit these long pauses, and hopefully that's where we are. I'm curious as to how much that 200-day gains week over week.
Ooh, that's a great question. Yeah, that's something. I may calculate that this week. So maybe that's tune in next week for Miles furiously pulling a spreadsheet out and figuring out the moving average move.
Well, for the listener,
that sounds like a nightmare. Let's hope none of our listeners remember I just said that, because I'm probably not going to do it.
For the listener, don't hold out for that, right? But just know that the 20-day is a lot steeper climb than the 50-day, which is a lot steeper than the 200-day. So it's a much flatter line. And when the 200-day is up at all, that means it's been quite a fun bullish ride.
Yeah.
Right.
Exactly.
So,
So if we get back to where this big run in gold started back on about August 20th is where it really took off, and the spot price of gold sitting right at 3,300. Do you know where the 200-day moving average is today, Rob? Hint, hint.
Let's say 3,300.
Exactly. It's 3303. So what's interesting is right now, as we possibly are peaking out in the price of gold, the 200-day moving average is exactly where this move started. So by the time we work our way down through some of these fib retracement levels, balance out the RSI and the divergence we've seen there, that's going to allow these moving averages to slowly catch up. And what we're probably going to see is gold finding a middle ground, obviously somewhere between where it started and where it ended. And I bet you we're going to stair step through some of these fib retracement levels. Give us a couple months of some sideways trading and pick up where we left off. So, man, the opportunities are probably going to present themselves again. We always try to point out whenever we get a break, that really is when you should be trying to do something with your metals. You shouldn't be chasing, if you can help it. We certainly don't want to chase the profit. What we want to do is we want to look for opportunity.
And you can't focus on dollars. I mean, in this type of a market, Miles, you described an 8.5% peak to trough pullback here in the last 48 hours. That's a $375 move. You guys, that's in 2 days. That's enormous. In the past, that was unfathomable.
Yeah, gold used to be $375.
That's right. It did? How old are you?
I think that's about where it was when you and I came to work here, Tori. I think it was around $350, if I remember correctly.
You precede me a little bit.
But it is important to focus on the percentages, because we're in a whole new world now.
Don't get discouraged by a $300 drop. It sounds like, the party's over. It's not. It's 8%. So focus on the percentages, focus on the moving averages, focus on the Fibonacci retracement levels as support. That's what they are. They are support. And that's where the runner catches his breath. And that's what everybody needs to focus on. And let's look at the same type of activity in silver, because it's also very encouraging. These numbers, it just doesn't free fall until some big buyer steps in. These are algorithms. These are traders. These are targets.
Totally.
This is opportunity to step in. It's called buying the dips when you find the floor, because the bull market is still intact. And, Miles, you've got an excellent chart on silver, and the fact that we already came down to the 382 Fibonacci retracement from what I'm looking at here. Is that right?
Yeah, we had a nice touch today. which I appreciate. I think we almost touched it or may have touched it yesterday as well. But yeah, we had a nice touch today. The 20-day is just above that. So looking at some of those shorter term moving averages, the 20 days just above that as well. We had a cross there also. There are times where gold and silver turn different directions and they go down different paths. But right now on this type of correction, we're definitely seeing similarity between both gold and silver. I don't know how many times we can say it, Tori. Gold leads the charge, silver follows behind. It's always the case. Sometimes silver may drink a Mountain Dew and go charging ahead of mom, but eventually it comes back to where it's supposed to be. And with silver kind of following on the heels of gold here a little bit, making up a little bit of ground, which is nice, but we're seeing the same patterns play out. You've got the same sort of thing happening in silver that you do in gold, like with the moving averages. You know, silver started this leg of the run at around $37.40. Your long-term moving average is at like $36.75 right now, working its way up there. So yeah, I think what gold does here, depending over the next week or two, if we see a continuation down, that'd be great. If we see it turn around and keep climbing, that always scares the tar out of me because I don't like when gold goes up in terms of dollars because gold doesn't go up.
Not
the
like
dollar
it
goes
has.
down.
Yeah.
Without some, again, underlying fundamental or piece of news that's driving it. That's when you know it's money jumping in and it's speculation. But we're talking about a 20-day and a 50-day moving average. To come down to touch the 20-day, we've said on this show for 3 weeks straight now, expect it. To come down and touch the 50-day moving average, we've said on this show for 3 weeks, expect it. We don't know where it's going to be because it matters when it happens. Those numbers are climbing. But right now, Miles, you allude to the fact that silver came down and touched that 20-day moving average. And that's great. If we bounce off that, this market stays hot.
Yeah.
I think by the end of the year, we're coming down to touch the 50-day, which right now in silver is about 43.50. And then with gold, I'm rounding it out there. But with gold, be encouraged there as well because similar price action. You've got the 4,000 or 3,990 is just the 382 Fibonacci. But from a moving average standpoint, you talked about 4,022 as a 20-day or so, and then like around 3,700, if that's right, for the 50-day. Expect that. You guys, that's healthy bull market activity to come down to do that.
Sure.
Yeah.
Well, and here's what's fun. So going back to gold real quick, since we're talking about moving averages. So the last time gold touched the 100-day moving average was August, and then it shot up 35%, 32%. The last time gold touched the 100-day moving average prior to that was January. Gold shot up 35%. The last time gold touched the 100-day moving average prior to that was February of 2024. Gold went up 39%.
So really what we should be doing is watching the 100-day.
Maybe.
Not only watching, like cheering it on.
like
That's
a
the
horse.
runner. That's the horse we want.
Well,
in
as
this
soon as you
race.
it's like anything else, right? As soon as you recognize it, it'll stop happening. But
Yeah, I know. Once you think you crack the code cracks you.
exactly. Yeah. That's the double slit experiment for those of you who also get bored on the weekends and watch YouTube videos about physics experiments from the 1950s. The last time gold touched the 200-day moving average was November of 2023 at $1,937. So gold's been on a run. We haven't come back to a long-term average in a while. So maybe we pay attention to the shorter term ones until we're told otherwise.
I like that outlook and that 100-day moving average. I mean, that reminds me of the ratio call that we made at the start of the year.
At 104.
Well, anytime
Or in
that
April.
gold to silver ratio breaks north of 90, it's the subsequent silver performance. Miles, you had a beautiful chart
You
at the
did.
start
I remember
of the year.
this. Yeah.
And said, look, the smallest gain that we've seen in silver after the gold silver ratio broke north of 90 was 27.5%.
Yeah.
The largest we had seen was 72%. Well, that happened at the first of the year, and look where we are. Silver's up over 70%, and there's no end in sight. Now, the ratio did obviously go all the way to 104 after it hit 90, but it came down to 78 to 1 here as it clawed its way back from 104 down to 78.
And we're at 84 right now.
Yes, and now it's bumped back up. So do we go and see another break north of 90?
That would be interesting.
Right, we hit 85 yesterday on the ratio. We're 84 today. So I'm really excited to see what happens there because that's one of those things that you found, Miles, that now you can go back 6 times in a row. I'd say that's a pretty good streak.
Well, and I want to put a commercial break here for a second. If you want to see the charts that we're talking about, if you're listening to us without the charts, go to McElveny.com/radio and you'll see these charts. But one thing I do want to encourage our listeners to, because I know they talk to their friends and people were hearing all about the shortage of silver in London and how silver's about ready to take off to the moon, and all that was mitigated over the weekend. But I don't think it was a one-off event. I do think that there is an emerging shortage of silver, but it's not a crisis at this time, but I think it's going to continue. So you'll continue to see fundamental changes in supply and demand. I do think a lot of this profit taking is due to people in leveraged positions in futures contracts, ETF positions, which are, largely traded by Wall Street firms. So just hang in here for a while, but don't get sucked into the fear and the greed and the ego that you'll hear out there in the internet world regarding these markets. Let's come back to reality. Let's look at the charts. Let's talk this through. Let's see how history has been rhyming, and then chart your course accordingly.
Well, especially in the physical metals, the question to ask the listener or the investor, if you haven't invested yet, then that's something you have to ask yourself, why not? But if you have invested, why did you invest?
Correct.
Especially in the physical metals. If you're going to go out there and trade and try to sell at a top, watch it come back down to the 50-day moving average and rebuy, well, you're not doing that with your physical metals. There's too wide of a margin, too big of a spread. Keep that type of focus on paper, and then you're different than the core physical metals investor. So Miles, you and Rob and I were talking about this earlier today, and I think it's really key. Like, what is your purpose for investing? Because we're hearing all sorts of speculation.
Oh,
right?
Yeah. All kinds.
And more importantly than that, what's your process? Do you have an exit strategy? With that purpose, do you have a target exit number? Was this for profit? Was this for ratio trading? In which instance, the spot price doesn't matter at all. All that matters is the ratio.
All that matters is the ratio. Well, it's heartbreaking. Like when we broke 104 on the silver gold ratio, I think you had a client that wasn't going to move until it hit 105.
Yeah. I call them and say, hey, you need to bust a move and move some gold into silver here. And they're like, one more point, we'll do it at 105, which never happened.
Yeah. I mean, you just fall in love with whatever is in your head, but you have to do it in a logical. I mean, you weren't talking about student body left, student body right. You were just talking about, let's take some of this and move it.
That's exactly right. And I'm glad you brought that up because they were enamored with gold. You guys, if you'll remember, it was all about tariffs and market uncertainty, and the equities markets were so unstable. Remember? Nobody would dare sell their gold. And it's not that they were wrong. It's gone from 3,000 to 4,300 in that period of time.
Yeah.
But it's about the relative performance of gold versus silver. Silver since then has far outperformed gold.
Until today.
Where
it goes back to 85. Or 84.
Yeah.
So,
but I mean, it's the relative value. And now nobody wants to part with their silver because they say it's going to 100.
Right.
I'm not saying you're wrong. I'm just saying if that is your purpose for investing and your process is ratio trading, stick to the process. Let your advisor educate and inform you on that. And that's what we do. We'll tell you when to move gold to silver and silver to gold. And it's a very emotional event. You have to have a plan and not get wrapped into the emotion of the moment.
Oh, so true.
It has nothing to do with the emotion.
So true.
That's that Warren Buffett mindset. Like if you know something is the right thing to do, you set up your plan, and then regardless of when it happens, you enact the plan. You can't care about timing, and you absolutely can't get caught up in the moment because you asked a second ago, what are your clients talking about? Well, I don't know about you guys, but I'm getting a lot of calls talking about the result of the backup in deliverables for silver, the London backup. Which Dave and Kevin talked about on the weekly commentary last week, the backup at refineries. So we've got a bunch of things getting thrown into the mix in the silver market just within the production of the material itself. And then you throw on an increased margin requirement because the prices are rising in the CME and the Shanghai exchanges are both trying to cut it off at the knees because they don't want it to get out of hand. So if you're coming into the silver market over the last week or two and looking at it just based on the chaos that's going on in the market right now, you don't realize that for those of us that have been around for 20, 30, 40 years, this is the who knows how many times we've seen this sort of thing happen. It's going to be over in a couple weeks. We had the same thing happen in gold 6 months ago. Everybody was panicking about London being 6-8 weeks out on delivery for gold shipments.
Correct.
That took care of itself over time. So, Tori, I think you're 100% right. You have to approach this stuff with a plan in mind. And you gave a plug a second ago, Rob. I'll toss one in here. Sit down with your advisor at McIlvaney Precious Metals. Come up with a plan now so that you know how you're going to navigate through things when they present themselves in the future. So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. As Rob mentioned a second ago, if you liked what you heard and you aren't familiar with our show on either YouTube or on our website format, head on over to mcilvaney.com/radio, where you can catch the video with all of the charts we put in. And as always, if you would like to speak with one of the advisors here at McIlvaney Precious Metals, you can reach us at 1-800-525-9556. Thanks again.